Please welcome Mark Dinner, who's the founder and chief investment officer at ICW and co-led the research team for Ray Dalio, to talk to us about what causes reserve currency transitions. Thank you, Mark.
Okay, I finished my speech here 20 minutes ago, and I asked ChatGPT how long it would take. So they say 32 minutes if I speak at a normal pace, so we'll see. Okay. Last time I gave a speech like this was in 11th grade, so we'll see how I do. Okay. All reserve currencies are temporary. So typically they last centuries, but eventually they fall. This was true for the gold coins of Roman and Chinese emperors, the Dutch guilder, the British pound, and it will be undoubtedly true for the US dollar eventually. It is such an important time to be discussing this topic. I believe we're living through a shift in the global currency regime now, and this shift may take decades, but the current administration has accelerated it in a way that the tectonic plates underlying the system are now moving faster than we may even fully appreciate. This shift has massive implications for investors and everyday citizens, and the consequences are playing out as we speak, from Israel's strike on Iran to the tariff policy of the current administration to the debate over the fiscal bill. And in all of these areas, the underlying drivers of the regime shift are evident, and we can talk about that. To boil it down, there are three scenarios I see. This is skipping ahead a bit of the framework, but I think if the situation is managed well, we can see the US dollar-dominated system shift to something else, perhaps a more bifurcated system in a slow, largely peaceful way, similar to the way we shifted from the pound to the dollar at the end of World War II to today. If managed poorly, the US faces a more accelerated and persistent decline in the dollar that could produce an inflationary spiral in the last decade. By the way, that occurred with the UK in the 1970s, but not to the degree of the Weimar Republic, but is a pretty classic way for how currency regime shifts occur. Typically, inflation spirals occur when the government has too much debt in a currency it can't print, big budget deficits, which it funds by abusing the printing press and monetizing government deficits and debts. Both internal and external geopolitical conflict and wars often undermine the incumbent superpower and its currency as a global reserve. The US is at risk across these factors, save for the fact that the US government debts, and this is important, are in a country that the Fed can print, and the currency is the world's reserve currency. This is what makes the current case both fascinating, why the reserve currency shifts of the US, and it's also why the reserve currency shift of the US is intertwined with its position as a global superpower. Another scenario is basically more of the same and perhaps a more glacial shift. While the US has debt to GDP that we just talked about of 120% to GDP and the largest budget deficit outside of a recession since, other than 2008 or 2020, since World War II, the dynamics that produce a regime shift are playing out, and it's a fair point that these dynamics are quite slow. Sophisticated investors have been discussing a regime shift in the currency for decades. Moreover, the US debt and deficit situation is a critical factor, but it's not the only one. US leadership and innovation and the US military supremacy are critical factors as well, along with US cultural influence globally. In a more optimistic scenario, at least from the US perspective, other countries might prefer a different path, the US technological dominance in AI and other areas of innovation could produce another decade of a US economic exceptionalism, which alongside potentially elevated but managed inflation could bring down the debt burdens and prolong the US dollar as a reserve currency. The range of outcomes above is so wide that it's critical for investors to think very differently about the coming decade than perhaps many have become accustomed to thinking and investing over the past, to think very differently about the coming decade versus the past decade. The way the current administration is forcing the issue across both internal and external imbalances and conflicts, for example, through tariffs, which amount to a trade war, or clauses like 899 in the current bill that threaten taxes on the income on foreign asset holders, which threatens a de facto debt default on U.S. assets, or a stated preference for a weaker dollar and an easier Fed, or expanding the budget deficit while looking to cut longer-term spending and slash regulations to produce a growth miracle. All of these policies are being shifted so fast, it feels like we're operating in policy in warp speed. And it's when things are moving so fast that it's even more important to take a step back and remind ourselves how the machine works. I do that below and then return to the current situation in the conclusion. In my view, there's basically 5 factors that enable a currency to have its currency, enable a country to have its currency be the reserve currency. 1 is economic, 2 is financial, 3 is military, 4 is political, and 5 is cultural. The typical arc is as follows. First, a country's economy increasingly produces stuff, goods and services, that other countries want. Increasingly, buyers and sellers transact in the currency. This occurred with the US dollar in the late 1800s and early 1900s during the Industrial Revolution. Second, the country's banks begin financing more global activity and eventually become the dominant banks in the world. This may occur with increasing trade finance, as it did in the US case, and is occurring to some degree in China, and then expand to domestic banks lending abroad and eventually foreign banks lending in their reserve currency. Third, the country's military becomes the dominant military force in the world. Often, wars catalyze a shift. This is what occurred in the shift from the Dutch guilder to the British pound, and similarly, World War I and World War II provided the catalytic shifts for a move from the pound to the dollar. Fourth, the country's political regime becomes the dominant global political actor. Typically, this means the country can write the rules of global trade and finance, locate institutions within the country, and design regimes that are centered around the home currency. The US did this with Bretton Woods after World War II. We have the IMF based here in DC. I came from New York. The UN is based there. Those are all signs of the way in which the US wrote the rules of the Bretton Woods system following World War II. Sometimes the way a country exerts force can also backfire. For example, the imposition of gold reparations on Germany by Allied forces, especially France, which drove Germany to suffer hyperinflation in the 1920s, which created the environment for Hitler and the Nazi regime to rise. Fifth, a country's culture becomes the dominant cultural force. This is a more intuitive argument, but it's also compelling to me. Ultimately, the backbone of a currency is faith. This is a really important point. And even in the case of a gold coin or a gold-backed dollar, each person in a society must agree to transact and save in the same coin. And for that to occur, there needs to be faith at some deep, fundamental level that the currency and that the society works. Typically, a currency has a logo, a face of a leader, or a symbol. This is true of gold coins back to Roman days, all fiat currencies, and even Bitcoin. Culture is embedded in this. It's hard for me to imagine a currency lasting very long, certainly not globally, unless literally billions of people buy into using the currency and the country's system, or for example, the dollar, or even a DeFi system like Bitcoin or Reserve. Okay, so before going too far with theory, let me now turn to some empirical facts about currencies, and then we can look at shifts in reserve currencies through time. First of all currencies die or devalue. That is the title of a paper I co-authored with Ray Dalio, now part of his chapter on the changing value of money in his book, The Changing World Order. We can see this point in the chart below, which shows the shifts in the relative value of the 3 reserve currencies of the last 500 years. So we see the Dutch guilder, which is NLD for the Netherlands. We see the British pound, which is GBR, and then we see the United States dollar, which is USA. So you see that the Dutch guilder was basically the dominant currency from 1600 to its decline following the Fourth Anglo-Dutch War in 1790. Then you had a bank collapse. The Bank of Amsterdam collapsed. The Dutch East Indian Company became over-indebted. Then the pound took over as the global reserve currency. That continued until World War I, when there was one shift, and then another shift after World War II when we shifted to the dollar. But importantly, it's also worth noting all of them versus gold have basically gone to zero if you didn't collect interest on them. So basically, it's a really important point. The three most successful currencies of the last 500 years, each of which served as the world's reserve currency, have been consistently devalued versus gold and other stuff. That's better than most. About half of the major fiat currencies, major fiat currency countries today have seen their currencies destroyed in the value over the past few centuries. So Germany, we'll go to next page. Germany suffered hyperinflation during the Weimar Republic of the 1920s. France also went through a hyperinflation in the 1920s following World War I. Japan suffered the same fate as they successfully initially operated quantitative easing in the 30s. And then as they became more aggressive doing that with their war efforts in the late 30s and abused the printing press, they had a hyperinflation as well. Italy, Germany, and France all suffered a collapse in their currencies during World War II. So basically, the first three charts I showed you are currencies, the guilder, the pound, and the dollar. That was probably the best you could do versus the other currencies. Part of what's been integral to the dominance of reserve currencies is the twin innovations of central banks and fractional banking. Fiat money in this system involves being paid in interest to compensate for the value of money and risk premium of parting with cash. Giving up one's cash to deposit in a bank that will then lend it out includes, entails taking risk, and that typically involves investors asking for a risk premium, as well as a risk premium for compensating for the cost of inflation eroding the value of money over time. So when we look on the next chart at the return of holding the reserve currency versus stuff or versus gold, it looks more attractive. So here we show the returns of the currency rather than holding spot, like just the printed paper under your bed. Now it's what's the return of holding the currency with the interest rate. You see that some of the currencies have performed better than gold, and some of them have performed worse. And so about half the currencies, if you held those, you'd be wiped out, and then about half you would survive. So the half that you get wiped out would include Italy, Japan, Germany. It doesn't quite show it here, but Spain, you'd be pretty close at certain points. And then you have the dollar, the pound, really as the ones that stand out, having retained their value. Next chart, we can see the real return of the currencies versus inflation rather than versus gold. And so that's just another way of seeing the same point, which is that about half of them you lose all your money and about half of them you don't. One more way to see that is this table here, I guess 13, 14 years ago. And so you see basically Germany, France, Italy, Japan, 1850 to present, you would have a negative return. Basically means you get wiped out. And then the other currencies, that's not the case. If you look at the average of holding currency versus and holding currency in the T-bills versus holding gold, it's about a 1.2% return for the currencies and 0.9 for just holding gold. And that's over 1850 to the present. 1850 and 1912, it's more, positive return for the currencies, 3.6 versus negative 0.3 for gold. And 1912 to present, when you have more printing with fiat money, it's negative 0.1 versus 1.6% for gold. So with that context, we can turn to the question, what causes the shift of reserve currencies through time? So for me, one easy way to understand this is just look at the power of each country's reserve currency within the framework we laid out above. So this is shown below. Right. So in this chart, we see basically this chart, they don't, all of these are from, most of these charts are from the changing value of money that's available, the chart set's available on the web and linked here from Ray Dalio's book. But this chart doesn't literally say what's in it, but you could imagine that's basically the holdings, the dominance of a country's reserve currency relative to other currencies. It's more labeled the dominance of the actual empire or superpower. But you can basically see that the Dutch Empire was at its height from 1600 to 1750. It started declining. 1790, with the Fourth Anglo-Dutch War, it really lost power. The UK was increasing during that period, with the Industrial Revolution starting in 1700, really took off and surpassed the Netherlands by the end of the 17th century. And then we had the pound as the dominant currency from, let's say 1790 to the end of World War I. And then with the end of World War I, you had the U.S. rise with the Industrial Revolution, and then the U.S. dollar taking increasing share of global reserves starting in World War I and then increasingly after World War II. So, as I said, ultimately having a reserve currency rests in the foundations of power and faith. And so the reasons for transacting in the currency and holding it as a store of value must be overwhelming, and there must be widespread faith in these things. That has been the case with the guilder, the pound, and the dollar, and for good reason. The Netherlands Dutch East India Company accounted for a third of global trade in the 1600s and represented the world's first and largest multinational company traded on a stock exchange, another innovation of the Dutch Empire. The Netherlands accounted for a huge portion of global innovations at its height, I think 30%, and a few of the most powerful innovations the Dutch produced included the central bank, fiat money, and as noted, the stock exchange and multinational corporation. So basically, capitalism as we know it. At the core of the Dutch empire was the innovation and dominance in shipping. This was the central innovation at the heart of the Dutch Empire and the guilder's role as a reserve currency. The Dutch Empire essentially fell after the British defeated the Dutch in the Fourth Anglo-Dutch War from 1780 to 1784. The war left its fleet depleted and its control over shipping routes massively curtailed, which in turn left the Dutch East India Company severely indebted and eventually led to a classic bank run on the guilder and the Bank of Amsterdam, which gave rise to the British Empire. The UK was the center of the Industrial Revolution, and London the financial capital that funded it. So it's not surprising that the UK rose to dominance as a global superpower following its victory in the Fourth Anglo-Dutch War, and the pound rose along with it. Importantly, the UK Navy emerged as the dominant military force on the Blue Seas during this time. Military supremacy on the seas is vital to being a global superpower. It's the hallmark of what creates a global superpower and underpins a global currency system over the last 500 years. We see this shift so clearly play out in the war that catalyzed the shift from Dutch to British dominance. Similarly, dominance over the waters was a critical factor in the victory of the Allied forces in World War I, thanks in good part to the British Navy, and then in World War II, thanks to the ability of US and UK forces to ultimately overcome the threat of German U-boats and naval strength. This is not only because of pure military strength to win a global war, it's also about the power to enforce peace and enable commerce by protecting shipping lanes required for global trade. The UK was the world's navy in peacetimes during the 1800s, and the US is the key peacekeeper of maritime trades today. Similarly to the way in which the Dutch Empire declined, the UK ended World War II massively in debt and in need of deficit reduction and a weaker pound to produce inflation and bring down debt burdens. While the US needed to bring down its own wartime government deficits, its dominance by this point led to the rise of the dollar as a reserve currency. As an aside, the US government debt to GDP was 120%, basically at the end of World War II. And so the combination of inflation and growth following World War II brought US government debts from 120% to I think 30%, and the same combination brought UK debts from I think 250% to under 70% by the early 70s. And so while there's a lot of talk about US debt and the problems of that, which are real today, there's also a path out, which I'll talk about. So just as the dominance of Dutch in shipping led to the rise of the guilder and the Industrial Revolution led to the rise of the pound, the second Industrial Revolution in the U.S. and subsequent U.S. dominance in innovation and technology, alongside financial and military strength, have led to the rise of the dollar as the world's reserve currency today. Many of us have lived through the peak of U.S. dominance as a global superpower, at least from what we see looking back, which I would argue was around 1990. At that time, the U.S. experienced a productivity boom from the computer revolution, the budget deficit was closed, and the government basically balanced the budget. The U.S. government debts had been brought down to manageable levels, and even though Ross Perot was already prematurely ringing alarm bells, and the U.S. was the dominant political, financial, military, and cultural force globally, with pretty much without rival, the situation looks very different today. Economically, the U.S. continues to be the global leader, financially as well. But given how unsustainable the U.S. deficit and debt situation is, and given the conflict we have internally that makes it hard politically to address the underlying problems, and given the foreign geopolitical conflict that is producing an increasingly aggressive policy stance, the path of U.S. debt and faith in the dollar system are set to be tested in a big way in the coming 12, 24, 36 months. Meanwhile, China has emerged as an economic superpower, and while hobbled by a domestic debt crisis, still has potential to grow its financial role, especially in spheres of influence. And in the areas of military strength and also innovation, China is catching up and testing U.S. supremacy. China now has more naval carriers than the U.S., rumored to potentially have longer-range missiles. China is years ahead in automated manufacturing, and DeepSeek shows the potential for Chinese AI. The U.S. has been the leading geopolitical force, and despite the current administration pushing to reduce the U.S. support of institutions like the UN, the U.S. continues to be the dominant political force, just now being enforced and realized through bilateral moves versus coordinated ones. How much the U.S. can continue to play the global role that it's playing and retain the dominance of the dollar amidst strains in government finances and domestic conflict internally remains a question. Let me just go through a couple charts that show some of these dynamics. So the first chart is the Dutch East India's balance sheet. So you can see, following the war that I've mentioned a couple times, the Fourth Anglo-Dutch War, which wiped out a bunch of the Netherlands fleet, or the Dutch Empire's fleet. In order to keep afloat, the Dutch East India Company took on a bunch of debt, so it basically levered up its balance sheet, and that was problematic. The Bank of Amsterdam around that time had shifted from a currency, the guilder, that was backed, using a currency that was literally coinage, silver coin, to using a currency that was backed with silver behind it, which was the guilder notes issued by the Bank of Amsterdam. And as they had these financial problems, there was a classic run on the bank. And so that was also problematic to the Dutch Empire retaining the guilder as a reserve currency. The next chart is a really cool one, which shows the returns of investing at 50-year intervals in the Netherlands. And you see that 1610, you would have done great. You would have done well, but not quite as well. 1650 to 1700, humorously, we kind of jump over the tulip bubble exploding, which was 1650. 1700, the returns are still pretty good, and then devastating as the currencies wiped out in the late 1700s. This chart now moves to the UK situation. So the UK had this massive decline in debt burdens following World War II, which enabled it to kind of retain a significant role in the global economy, but still at the same time that it was losing the pound as a reserve currency. So we started with total debt in the economy at 395% of GDP, and it would decline by between 1947 and 1969, it declined to 146. So you had a huge decline of 249% debt to GDP. And the primary reason for that in a nutshell, was that nominal growth was above nominal interest rates for a sustained period. So we had very strong nominal growth in the UK during that period, 6.8%. Real GDP growth was quite strong, around 3%, 2.9. You had elevated but still contained inflation of 3.9%. And so that adds up to 6.8, and the bond yield was 5.2, so you're basically growing the economy faster than you're paying interest. So here's just empirically what happened with UK debt. So you can see it was 250% debt to GDP, and by the 1970s, it was 30%. So that just shows you, you can see a chart, which I'll show you in a minute, of the US at seemingly an unsustainable level, but these things can shift over time. So staying with the UK case, but kind of double-clicking on what was going on. So one of the key ways in which the UK reduced its debt burdens was by having a devaluation in the currency. So if you can see where it says you have a kind of a red circle around negative 3%. So what that's showing is that from 1947 to 1959, the UK had a 3% annual devaluation. Part of that came very fast with devaluation, I think, in September 1949 of the pound to the dollar. That helped. The story with the UK is basically they came out of World War II with a lot of debt. They tried fiscal austerity. That was very painful. Then they moved towards devaluing the currency. They had a big devaluation of the pound. That helped stimulate the economy. It helped also produce inflation, and that's partly what produced the strong nominal growth that outpaced nominal interest rates. Meanwhile, the Bank of England was keeping interest rates, low enough to allow for that dynamic to play out. So that was 1947 to 59. As a result, growth was almost 2.8% higher than the bond yield. And then 1960 to 69, the dynamic played out a little less extreme. So growth was 0.3% ahead of the bond yield, and the pound devalued 1.5% a year. You can see the attribution of the debt burdens here. This chart almost killed me, and I think it was 2010, 2011, we're studying basically like how is the U.S. going to, what does a deleveraging look like? What is a beautiful one versus an ugly one? So you see here the U.S. reflation, 1933 to 1937, where you had real growth and inflation help erode the debt burdens coming out of the Great Depression, and a little bit of defaults. In the UK case, 1947 to 69 is quite interesting because you had a significant amount of inflation erode the debts, like 4% a year, as I was describing, some real growth. And then the combination of those things basically offset interest payments. And then you had basically dissaving, people paying down their debts, both the government and the private sector, in a way that reduced the debt burden further. So this is the US debt situation. So we see here, end of World War II, 120% debt to GDP, basically exactly where we are today. And then the question is, how do we manage it? It's clearly unsustainable. I think about the same amount that we spend a year on defense spending, 800 billion to $1 trillion, is roughly the same amount we're going to be spending on interest payments. Obviously not healthy for an economy where you want the government, if it's spending 800 billion, to spend it productively versus interest. But there's also multiple ways it could play out, as I was describing. Right. And then this chart looks pretty good for the US as a reserve currency. So basically it's showing where is data center capacity located for the hyperscalers. And you can see, well, interestingly, North Virginia is by far the dominant location. Beijing is next. Shanghai's a couple below, but if you add up Oregon, Iowa, Ohio, Silicon Valley, Dallas, Virginia, South Virginia, Arizona, you get to a point where the US is pretty clearly the dominant superpower in terms of data capacity. Okay, don't need that. don't need that. Okay, so those are basically the charts I wanted to say. I can go a little bit towards the investment implications, and we can have time, Nevin, to talk through some of this. So picking up on that chart here, it shows just how dominant the U.S. is in data center capacity for AI due to the hyperscalers and where they're investing. And on this point, I was recently at a cocktail event and had time to hear from and speak a bit with Nouriel Roubini, which sounds like something you would say at a cocktail event, but it's true. His point was that as much as there's concern and talk about the U.S. debt situation, perhaps more important than treasuries is tech and AI. So he suggested the AI will produce a productivity boom that could generate 3 to 4% real GDP growth in the coming decade. That would be huge. So coupled with elevated, moderate, and controlled inflation of around 3 to 4%, GDP growth of around 7 to 8% would be massive. And if the Fed kept rates contained around 4 to 5%, the U.S. could grow out of its debt problem in the same way the UK grew out of its debt problems from the end of World War II, when the UK debt stood at 250%, as I showed, to below 70% by the early 70s. To conclude, we are in the midst of a shift in the global world order and currency regime. The U.S. is at a crossroads and looks a lot like the UK around the time of World War II. Whether the U.S. dollar declines like the pound, and whether that is a peaceful or violent transition, the determinants of these questions are playing out real time in profound ways. And whether even the shift occurs is a big question based on the potential for the U.S. to have technological dominance going forward. For investors, it's critical to think through ahead of time how your strategic asset allocation will perform in different economic and market scenarios that could arise from this shift. As part of this, it's incumbent for investors to separate their decision about what is the optimal strategic asset allocation from the current question of what is the strategic currency mix that is optimal to hold in the current environment. This may sound very assertive, but I truly believe if the CIOs or advisors managing one's savings are not thinking through and actively wrestling through these questions with their investors, especially with respect to one's optimal currency mix and strategic asset allocation, if they're not doing this, it's borderline irresponsible. We are living through a shift in the global currency regime. Not paying attention to that has in the past meant the difference between retaining and compounding one's wealth and being totally wiped out. This is true for the most prominent investors in Germany and France in the 1920s, Germany again in the 30s in World War II, Italy and Japan in the 30s and World War II period, the UK during its stagflation and inflationary spiral in the 70s, US investors during the Civil War. What currency to hold is perhaps the most important question an institutional investor faces over the long term, arguably more important than what asset mix, though they are often intertwined in practice. If the answer is one currency, it is probably the wrong long-term answer. I look forward to sharing more thoughts and discussing these issues with you later today and in the future, and look forward to talking with Nevin now about some of them.
Excellent.